Ladies and gentlemen, something happened in the silver market that hasn't occurred in over 4 decades. The price of silver punched through $93 per ounce. Let me say that again, because most people scrolling past this video right now have absolutely no idea what that means. $93. For perspective, just 18 months ago, silver was trading at $22. That's a gain of over 300%. Fortunes have been made. Fortunes have been vaporized. And right now, at this very moment, there's a war happening in the financial markets that could determine whether you're about to witness the most spectacular commodity blow off top of your lifetime, or the most devastating trap ever set for retail investors. Because here's what nobody's telling you. While the Momo crowd, the momentum chasers, the Wall Street bets warriors, the TikTok traders are all piling into silver screaming that $100 is inevitable, that it's destiny, that this is the big one, there are massive institutional players quietly moving billions of dollars in the opposite direction. And the question that will determine everything, the question that could mean the difference between generational wealth and catastrophic loss, is this. Is silver's moonshot to $100 per ounce the beginning of a new supercycle? Or is this the greatest liquidity squeeze in modern history about to snap back and destroy everyone caught on the wrong side? Stay with me, because what I'm about to show you is going to fundamentally change how you see this market. Right now, there are approximately 4.7 million retail investors holding silver positions. Most of them bought in the last 90 days. Most of them have never traded commodities before. Most of them have no idea what's actually driving this rally or what's waiting for them at the top. But before we get into the machinery behind this move, before we dissect the supply deficit everyone's talking about, before we examine whether the Federal Reserve's next decision could send silver to $120 or back to $60, I need you to understand something critical. This isn't just another commodity rally. This is a liquidity event. And liquidity events don't follow normal rules. They don't respect technical analysis. They don't care about your entry price. They end when they end, violently and without warning. And the people left holding the bag are always the last ones to arrive. So let me take you back to where this really started. Not last week, not last month, but to the structural setup that's been building for years while everyone was distracted by crypto and tech stocks and everything else. The global silver market has been running a supply deficit for 3 consecutive years. That means more silver is being consumed than mined. The Silver Institute reported that in 2024 alone, the deficit reached 215 million ounces. To put that in perspective, that's roughly equivalent to the entire annual output of Mexico, the world's largest silver producer. Now you might be thinking, okay, supply deficit, price goes up, basic economics. But here's where it gets interesting. Here's where the machinery starts to reveal itself. That deficit isn't being caused by jewelry demand or investment demand or even solar panel demand, though all of those are up. The real driver is something most people haven't even considered, the artificial intelligence boom. Every AI data center being built right now, every server farm that's powering ChatGPT and Claude and Midjourney and every other AI tool that's transforming our world, they require massive amounts of silver. Silver is the most conductive metal on Earth. It's irreplaceable in high-performance electronics. And as Microsoft and Google and Amazon and Meta race to build trillion-dollar AI infrastructures, they're consuming silver at rates that are outstripping even the most aggressive mining expansion plans. According to recent industry data, AI-related silver demand has increased by 47% year over year, and it's accelerating. But here's the problem. You can't just turn on a silver mine. The average timeline from discovery to production is 7 to 10 years, which means the supply deficit we're experiencing right now is locked in for the foreseeable future. The silver that would solve this problem doesn't exist yet. It's still in the ground, and this is where the story gets absolutely wild. On January 7th, just 1 week ago, JP Morgan released an internal memo that was subsequently leaked to Bloomberg. In that memo, their commodities desk put a price target of $108 per ounce on silver by the end of the second quarter. $108. Now, JP Morgan doesn't issue price targets like that lightly. They're one of the largest holders of physical silver in the world. They have access to order flow data that you and I will never see. They know where the big money is positioned. And when they say 108, the trading desks around the world pay attention. Within 48 hours of that memo leaking, silver rallied from $82 to $90. A 10% move in 2 days. That's not normal. That's not a gradual climb based on fundamentals. That's momentum. That's fear of missing out. That's leverage piling on top of leverage. And that's exactly when things get dangerous. Because here's what happens in these moments. Here's the pattern that repeats itself in every parabolic move in history. First, the fundamentals create the setup. Supply deficit, industrial demand, macro uncertainty, all real factors. Then the early smart money gets positioned, quietly accumulating while prices are still reasonable. Then the momentum players arrive. And this is crucial. They don't care about fundamentals. They care about the chart. They care about the trend. They see silver up 300%. They think it's going to 400%. They leverage up using options, using futures contracts, using every tool available to maximize their exposure. And then, at the very top, right before the collapse, the retail crowd arrives. That's where we are right now. The Google search volume for how to buy silver hit an all-time high last Wednesday. TikTok videos about silver are getting millions of views. Teenagers are opening brokerage accounts to buy silver miners. This is not a joke. This is actually happening. And historically, when the general public shows up to a trade, the smart money is already heading for the exits. But wait, you might be saying, what about the fundamentals? What about the supply deficit? What about the AI demand and the Federal Reserve and all the real reasons silver should be going higher? Those are all valid. Those are all true. But here's what you need to understand about liquidity-driven markets. Fundamentals determine the direction, but liquidity determines the magnitude and the timing. And right now, global liquidity is tightening. Not loosening, tightening. Let me explain what that means and why it matters more than anything else you're hearing about silver. The Federal Reserve just held rates steady at their January meeting. They signaled that rate cuts are still on the table but pushed the timeline further out than the market expected. When they did that, something critical happened in the overnight funding markets. The cost of leverage went up. Now, if you're trading silver futures, which most of the big momentum in this rally is coming from, you're using leverage, typically 10 to 1, sometimes 20 to 1. That means for every dollar you put down, you control $10 or $20 of silver. That's how you get these massive returns. It's also how you get completely wiped out when the market moves against you. And when the cost of that leverage increases, even slightly, it changes the entire equation. Traders who were profitable at 3% funding costs suddenly aren't profitable at 4%. They start to close positions. And in a momentum-driven market built on leverage, when the closing starts, it cascades. We saw this exact pattern in February of 2020 when crude oil went negative. We saw it in the meme stock squeeze of 2021 when brokers raised margin requirements and the whole thing collapsed in 72 hours. We saw it in the crypto crash of 2022. And we're seeing the early warning signs of it right now in silver. 3 days ago, the CME group, which operates the primary futures exchange for silver, announced they're raising margin requirements by 18% effective next Monday. 18%. That means if you're holding a leveraged silver position, you now need to put up 18% more cash to maintain that position. And if you don't have that cash, your position gets liquidated automatically. No warning, no appeals, just gone. Now guess what happens when thousands of leveraged positions get forcibly liquidated at the same time? The price doesn't gradually decline. It gaps down. It can drop 5, 10, 15% in minutes. And everyone who thought they were riding the silver rocket to $100 suddenly finds themselves staring at margin calls and catastrophic losses. But here's where the story splits into two completely different realities depending on who you listen to. On one side, you have the silver bulls, the true believers, many of whom have been predicting this moment for decades. People like Peter Schiff, who's been on record saying that silver is the most undervalued asset in the world and that $100 is just the beginning of a move that could take silver to $200 or even $300 per ounce. You have analysts pointing to the gold to silver ratio, which historically averages around 60 to 1. Right now, with gold trading near $3,000 per ounce and silver at 93, that ratio is roughly 32 to 1. If silver were to revert to its historical relationship with gold, the math says it should be trading at $50. But if gold continues higher, if we see the $4,000 gold that many are forecasting, then a 60 to 1 ratio would put silver at $66. And if we see any kind of monetary crisis, any kind of flight to hard assets, those historical ratios go out the window and silver could genuinely reach levels that sound absurd right now. Then you have the industrial demand argument. The green energy transition isn't slowing down. Electric vehicles use twice as much silver as traditional cars. Solar panel installation is projected to double over the next 5 years. And none of that accounts for the AI revolution we talked about earlier. These are real secular trends that support structurally higher silver prices for years to come. So the bull case isn't crazy. It's not based on nothing. There are legitimate fundamental reasons to believe silver has more room to run. But then there's the other side, the cautionary voices. The people who've seen this movie before. Jim Rogers, one of the greatest commodity traders in history, gave an interview 2 days ago where he said, and I quote, "I've been buying silver for years. I love silver, but what I'm seeing in the market right now scares me. When everyone wants to own something, that's usually when I want to sell it." Carl Icahn, the legendary activist investor, liquidated his entire precious metals position last month according to his most recent 13F filing. Why would someone like Icahn, who has access to research and data that dwarfs what retail investors can access, why would he exit right before the big move to 100? Does he know something? Is he seeing something in the liquidity data that hasn't shown up in the headlines yet? And then there's the China factor that almost nobody's talking about. China is the world's largest consumer of silver and the second largest producer. Their economy is in serious trouble right now. Property market collapse, deflation, youth unemployment at record highs. When Chinese industrial demand falters, and the data suggests it already is, that takes a massive bid out of the silver market. The Shanghai Silver Exchange has seen volumes decline by 23% over the last 60 days, even as prices have surged. That's called divergence. And divergence is usually a warning sign. It means the price action and the underlying demand are moving in opposite directions. Something has to give. So now you're sitting here watching silver at $93, watching the crowd scream that 100 is coming, watching the momentum build, and you're trying to figure out what to do. Do you buy? Do you sell if you're already in? Do you sit on the sidelines and watch? And this is where I need to give you the framework that actually matters, because everything I've told you so far is just data. The question is, how do you use it? Here's the truth that nobody wants to hear. Markets don't move in straight lines. Every rally, no matter how powerful the fundamentals, eventually pulls back. The only question is when and from what level. Silver could absolutely hit $100. It could happen next week, but if it does, what happens at 101? Does it pause? Does it consolidate? Does it rip to 120? Or does it collapse back to 75 as everyone who bought the top panic sells and the leveraged positions unwind? History suggests that round numbers, especially psychological barriers like $100, act as massive resistance levels. Traders take profits. New shorts get established. The very momentum that drove the price higher reverses. And the speed of the decline is always faster than the speed of the ascent, because fear is stronger than greed. Now, let me give you a scenario that keeps me up at night. Let's say silver does hit $100 next week. The headlines scream, "Silver reaches century mark for first time in history." Retail investors, the ones who've been sitting on the sidelines, they see those headlines and they flood in. They max out credit cards, they liquidate their index funds. They go all in because they're convinced this is going to 200. And let's say at the exact same moment, the Federal Reserve comes out with their next statement, and they signal that inflation is more persistent than expected, and rate cuts are off the table for 2026. What happens to the cost of leverage? It spikes. What happens to risk assets across the board? They sell off. What happens to silver when the margin calls start hitting and the forced liquidation begins? It doesn't gently decline. It craters. And suddenly, the people who bought it $98, $99, $100, they're down 20, 30, 40% in a matter of days. That's not hypothetical. That's exactly what happened in 1980 when the Hunt brothers tried to corner the silver market and drove prices to $50. It collapsed back to $10 in less than 2 months. Fortunes were obliterated. But here's the thing. I'm not telling you this to scare you away from silver. I'm telling you this so you understand the game that's being played. Because there are two types of people in this market right now. There are the informed players who understand position sizing, who have stop losses, who are managing risk, who have a plan for both scenarios. And then there are the gamblers who are all in, who are leveraged to the hilt, who are betting their financial future on $100 silver because someone on the internet told them it was guaranteed. And I can promise you this. When the music stops, and it always stops, only one of those groups survives. So let me walk you through what the smart money's actually doing right now, not what they're saying, but what they're doing. If you look at the COT report, the Commitment of Traders report that the CFTC publishes every week, it shows you the positioning of commercial traders versus speculators. Commercial traders are the producers, the refiners, the industrial users who actually deal in physical silver. Speculators are the hedge funds and the retail traders. And here's what's fascinating. Over the last 4 weeks, as silver has rallied from $75 to $93, commercial traders have been aggressively selling. They've increased their short positions by 32%. Meanwhile, speculators have increased their long positions by 48%. Now, why would the people who actually produce and use silver be selling into this rally? Because they know that these prices, while possibly justified by the fundamentals, are being amplified by speculation and leverage. They're locking in profits at levels they haven't seen in decades. They're hedging their production. They're being smart. And on the other side, you have speculators who are chasing momentum, who are buying at all-time highs, who are convinced it's going higher because it's been going higher. That imbalance is what creates the crash. Now, I want to address something that I know some of you are thinking. What about the silver squeeze? What about the movement to drain the physical silver from the vaults and expose the paper manipulation? Look, there are legitimate questions about the relationship between paper silver contracts and physical silver availability. The amount of silver traded on the futures exchanges every day dwarfs the amount of physical silver that actually changes hands. That's a fact. And yes, If there were a true delivery squeeze, if everyone holding contracts demanded physical delivery, the system would break. But here's the reality. That's not happening on a scale that matters. The vast majority of futures contracts get rolled or cash settled. They don't result in physical delivery. And the people pushing the silver squeeze narrative, many of them are already positioned, and they need new buyers to push the price higher so they can exit. I'm not saying it's a coordinated manipulation. I'm saying that in bull markets, the people who got in early always need the people who get in late. That's how markets work. And right now, we're in the late stages. But let's play devil's advocate for a moment. Let's say I'm wrong. Let's say this time is different. Let's say the supply deficit is so severe, the AI demand is so massive, the geopolitical tensions are so extreme that silver genuinely is going to $150 or $200. How would you know? What would be the signals? First, you'd see physical premiums absolutely explode. Right now, if you want to buy a physical silver coin from a dealer, you're paying about 8 to 12% over the spot price. That's the premium for fabrication and dealer markup. If we were heading into a genuine shortage, those premiums would go to 20, 30, 50%. We saw this in 2020 during COVID when premiums hit 40%, and you literally couldn't find physical silver for months. That was a real shortage signal. We're not seeing that yet. Second, you'd see industrial users publicly panicking. If Apple or Tesla or solar panel manufacturers were unable to secure silver for their production lines, that would be front page news. It would be supply chain crisis headlines. But we're not seeing that. The industrial supply chains are tight, but they're functioning. Third, you'd see sovereign nations making major moves. If central banks started adding silver to their reserves the way they've been adding gold, that would be a massive signal. It's not happening at scale. So what we're seeing instead is a momentum-driven rally built on real fundamentals, but amplified by speculation and leverage. And those rallies can go further than anyone expects. Silver could hit 110. It could hit 120. Irrational markets can stay irrational longer than you can stay solvent, but they always revert. The question is not if, but when and from what level. Now here's where this gets personal. Here's where you have to make a decision. Because I can give you all the data, all the analysis, all the historical context, but at the end of the day, you have to decide what you're going to do with your money. And that decision should be based on your risk tolerance, your time horizon, and your financial situation. Not on what some analyst predicted, not on what some YouTuber is screaming about, not on what your buddy told you at the gym. If you believe in the long-term fundamentals of silver, if you think the supply deficit and industrial demand justify higher prices over the next 5 to 10 years, then you should own physical silver. Not leveraged futures contracts, not options that expire, not shares in some junior mining company that could go to zero, actual physical metal that you hold in your possession or in a secure vault. And you should be prepared for that silver to be worth less tomorrow than it is today, because the path from here to wherever it's going is not going to be straight up. But if you're thinking about jumping into silver right now because you're afraid of missing out, because everyone's talking about it, because you want to make a quick profit, I'm begging you to reconsider. Because that's not investing. That's gambling. And the casino always wins in the end. The statistics are brutal. 90% of retail traders who jump into commodity futures lose money. Not some money, not a little bit. They lose their entire stake. And it usually happens faster than they ever imagined possible. Let me give you a real example that just happened last week. There's a Reddit user who posted his entire journey trading silver. He started with $50,000. He bought call options on silver when it was at $78. Within 10 days, those options were worth $230,000. A 460% return. Life-changing money. He posted screenshots. He was celebrating. People were congratulating him. He was a hero. And then he decided to hold because he was convinced it was going to 120. He didn't take any profits. He actually bought more call options with his gains. And then on Friday, silver had a 5% pullback in one day, just normal volatility in a parabolic move, and his options lost 70% of their value in 6 hours. He went from being up $180,000 to being down $15,000 from his original investment. That's the reality of leveraged trades. That's what momentum does to people who don't have a plan. So here's my framework, and you can take it or leave it. This is based on 30 years of watching markets do exactly what they're doing right now. If you own silver already and you're sitting on substantial gains, take some profits. Not all of it, but enough that if the market crashes tomorrow, you'll still be happy with the trade. Lock-in wins. They're not real until you take them. If you're thinking about getting into silver now at $93, ask yourself honestly, am I buying this because of the fundamentals or because of the momentum? If it's the fundamentals, buy physical and be prepared to hold for years. If it's the momentum, understand you're speculating and position size accordingly. Risk only what you can afford to lose completely. And for the love of all that is holy, do not use leverage unless you are a professional trader who fully understands the liquidation mechanics and margin requirements. And here's the signal I'm watching more closely than anything else. I want to see what happens when silver actually touches $100. Does it blast through and keep going? That would suggest genuine strength and possibly a move to 120 or higher. Or does it hit 100 and immediately reject? Does it struggle? Does it gap down on the next trading session? Because that would tell me that 100 is the top, that everyone who wanted to buy has bought, and the only direction left is down. That price action at critical levels tells you everything you need to know about what's really happening beneath the surface. Now let me address the elephant in the room that I haven't talked about yet. What if there's a genuine global financial crisis? What if the debt spiral that's been building for decades finally breaks? What if we see a currency crisis, a banking crisis, a sovereign debt default? In that scenario, all bets are off. Silver would likely go to levels that sound insane right now. When people lose faith in paper currency, when they lose faith in the banking system, they flood into hard assets. Gold, silver, real estate, anything tangible. We saw this in Weimar Germany. We saw it in Zimbabwe. We saw it in Venezuela. And if that's the scenario you're positioning for, then you shouldn't be trading silver at all. You should be accumulating physical precious metals as insurance, regardless of the price. Because in a true crisis, the price in dollar terms becomes irrelevant. What matters is what you can exchange it for when the system resets. But I don't think that's where we are right now. I think we're in a late-stage bull market in a specific commodity that's been driven by real supply-demand dynamics but has now entered the speculative blow-off phase. And those phases always end the same way, with a crash that destroys the late arrivals and hands profits to the people who got in early and got out at the right time. So here's what I'm watching over the next 2 weeks, and this is critical. First, the Federal Reserve's next move. If they signal more accommodative policy, if they hint at rate cuts coming sooner, that would be fuel for silver to push higher. But if they stay hawkish, if they prioritize inflation fighting over growth, the cost of leverage goes up, and this rally stalls. Second, I'm watching the Shanghai Exchange and Chinese import data. If Chinese industrial demand comes back strong, that's a genuine bullish signal. If it continues to weaken, that's a major red flag. Third, I'm watching those COT reports to see if commercial traders start covering their shorts. If they do, that would suggest they think the top is in and they're preparing for the reversal. And fourth, I'm watching social media sentiment. I know that sounds weird, but historically, when you see maximum euphoria, when everyone and their grandmother is talking about an asset, you're at or very near the top. We're getting close to that level, but we're not quite there yet. The Momo crowd, these momentum traders who have piled into silver over the last 60 days, they're not wrong about the fundamentals. The supply deficit is real. The industrial demand is real. The macro uncertainty is real. But what they're missing is the timing and the mechanism. Markets don't care about fundamentals in the short term. They care about liquidity and positioning. And right now, the liquidity is tightening while the positioning is at extremes. That's a dangerous combination. It doesn't mean silver crashes tomorrow. It means that when it does turn, it's going to be violent and fast, and most people won't get out in time. So am I saying silver won't hit $100? No, it very well might. It might happen next week. But I am saying that $100, if we get there, is more likely to be the end of this move than the beginning of the next leg higher. And the people who are going all in right now, who are mortgaging their houses and maxing out their credit cards because they're convinced this is their ticket to generational wealth, those people are playing a game they don't fully understand against opponents who have billion-dollar research budgets and algorithms that can execute trades in microseconds. This is the last stand for the Momo crowd against the reality of global liquidity dynamics. And history shows us that in that fight, the liquidity always wins. Always. The crowd gets steamrolled. The smart money gets paid. And 6 months from now, there will be congressional hearings about manipulation and rigged markets and how retail investors got screwed. But the truth is simpler and harsher. Most people lose in markets because they buy high and sell low, because they let emotions override logic, because they confuse a bull market with brains. But you don't have to be most people. You can choose to approach this rationally, strategically, with proper risk management and realistic expectations. You can choose to understand that making money in markets isn't about being right, it's about managing risk. It's not about catching every move, it's about surviving to trade another day. And right now, with silver at $93 and the crowd screaming that 100 is inevitable, the highest probability trade is not all in long. It's cautious, it's hedged, it's prepared for both scenarios. So here's my challenge to you. Before you make any decision about silver, write down your thesis. Not what you hope will happen, but what you actually believe and why. Write down your entry price, your exit price, your stop loss. Write down how much you're willing to risk and what you'll do if you're wrong. Because if you can't articulate that clearly before you put money at risk, you're not investing, you're gambling. And I promise you, the market will expose that faster than you think. The next 2 weeks are going to be absolutely critical for silver. We're either going to see a breakout to 100 and beyond that confirms this as a genuine supercycle, or we're going to see a rejection and reversal that traps everyone who bought the hype. And the data I've shared with you today, the positioning, the liquidity dynamics, the margin requirement increases, the commercial trader behavior, all of it points to one conclusion. The risk reward right here, right now, favors caution over aggression. But don't take my word for it. Do your own research. Look at the data, study the history, understand what you're getting into. Because this market doesn't care about your financial goals. It doesn't care about your retirement plans. It doesn't care about your dreams. It only cares about supply and demand and the cold mathematics of leverage and liquidation. Is $100 silver real this cycle? Maybe, probably even. But is it the beginning or the end? That's the question that will determine everything. And the answer is coming faster than anyone expects. If this analysis helped you see something you weren't seeing before, if it gave you a framework to think about this market differently, then smash that like button right now. Drop a comment below and tell me what you think. Is silver going to 120 or back to 70? Are you buying, selling, or sitting this one out? And if you want more content like this, real analysis without the hype, without the BS, just data and frameworks you can actually use, hit that subscribe button and turn on notifications because the next few weeks are going to be absolutely wild and you don't want to miss what's coming.